Good, everybody. This is going to be the second video of the bootcamp, and we're going to start the bootcamp with something very simple, which is going to be structure. Okay, so structure, what that means is we are going to be structuring our trades, right? It doesn't make sense for us to trade if we don't have structure in the market. Now, what this means is going to be very simple, right? Obviously, if you're here and you don't know anything about trading, you should at least know something about trading. All right, what I'm going to talk about is very simple, but still you should at least know, something about trading. Now, structure. When structuring a trade and when structuring, your draws on liquidity, you want to be having we're going to be using the daily and 4 hour, okay? So daily and 4 hour for draws, or draws on liquidity, okay? This is draw on liquidity. Now, we sometimes can use the 1 hour, but usually we're just gonna use the daily 4 hour and sometimes 1 hour, okay? So sometimes 1 hour, all right? Now, what we're gonna do with this is obviously structure the trade, and why I use the daily 4 hour and sometimes the 1 hour is because the higher the time frame, the more power, right? So obviously daily and 4 hour and 1 hour has more value than 15, 5, or 1 minute. Now, what you're going to do on the daily, 4 hour, 1 hour, what you're going to want to do is pretty much the simple things. So you're going to search you are going to search for high time frame liquidity / high time frame for value gaps, inverse for value gaps, BPRs, and pretty much just imbalances in general. Imbalances, okay? So that's what you're going to be looking for. So daily 4 hour, 1 hour structure, and then what you're going to be looking in these three, is going to be this. Now let's go, to the actual market and show you guys what I mean by this. Now, actually, let me delete this. All right. Now, if you go into the market, you're always going to see that we have two sort of draws on liquidity. So we either have liquidity, which is highs and lows. So this is high time frame liquidity. 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 Okay, all of this are high time frame liquidity. And then we're also going to have our second draw is going to be imbalances. So this is an inverse for value gap. This is a draw on liquidity. Okay, this for value gap is a draw on liquidity. All of this for value gap is a draw on liquidity. This for value gap is a draw on liquidity. Right? So what market does is very simple. Market always follows the same process, which is from internal, which would be imbalances, to external, right? And that's pretty much what it does always. But we are gonna numb it down even more, and we're just going to follow simple rules of trading, right? So what I mean when you're setting your draw on liquidity is, for example, let's set this day right here. Okay, this 10 a.m. candle. So let's go all the way down here. So right before this, let's set up. All right, let's set up our open. So this would be our open right here at 9:30 right here. This would be our open. So let's go over that. Yeah, damn, that shit pumped. So, all right, right before this actually. All right, so we're going to open the market, right? We're really close to our market open and we're trading. What do we go and see? We would go to the 4 hour, and what will we do and see? We would see, oh, we just swept this very high time frame liquidity, right? We just swept this, and we just swept this high, right? We just swept that high. We even swept this high, and we swept a lot of high time frame liquidity. Now, what did we leave on the downside though? We left a lot of imbalances, right? We inversed this, right? But we left a lot of imbalances. What does this mean? That we swept liquidity, and the next draw is going to be these imbalances to keep going up, right? So what is going to be your trade on this day? Well, your trade on this day would obviously be to short to all of these imbalances, right? After sweeping all of this liquidity. Oh my God. All right. So if you go to a lower time frame, you're going to see pretty much that's what we do. So we're going to open market right here, right? We just swept all of this liquidity. And what is exactly what we do? Boom. We go all the way down and fill all of this imbalances, right? So, and obviously after taking all this liquidity, we pretty much dumped 300 points, right? It's a very simple concept that, you know, a lot of people have learned from TJR, and that, but a lot of people don't even utilize anymore. And it's so simple because it genuinely does work, right? If we have swept high time frame liquidity, the next draw is going to be imbalances on the downside that we want to fill. So this is pretty much the explanation of how I manage my and structure my trades. So it would be from internal range liquidity to external. Well, actually, to external and back forth, right? So external to internal range liquidity. It always does this, okay? It pretty much always is doing this. Where do I have this? So it's pretty much always doing this, and right. So from internal, pretty much always does this, and then this. Okay, it's like a cycle. Okay, so that's pretty much how you would structure your trade, where you would see like, oh, we just swept very high time frame liquidity, then we want to go to, our fair value gaps. So this would be fair value gaps, and then the external would be the liquidity, right? So if you just saw we swept external range liquidity, which would be, normal liquidity, highs and lows, then you would go to your internal liquidity, which this would be your fair value gaps, and imbalances, because there's some other types of imbalances which I'm going to speak on another video. Okay, so when you do this, obviously you're going to pretty much have a very nice intuitive way of looking into the market, because you're just going to pull up the 4-hour daily time frame, and you're going to see that, oh, we just swept high time frame liquidity. What's the next draw? The next draw is going to be our fair value gaps or imbalances. Oh, we just swept, or we just entered a fair value gap, a bullish fair value gap in a bullish trend. What happens next? We're going to be going, right? We just entered the bullish fair value gap. What happens next? Oh, suddenly we go to the next external liquidity, which would be the high. Oh, magically it works, huh? How stupid. So, as I said, it's very simple. It's a very simple way of looking at the market, but it's very, very effective. And that's pretty much how I look at the market when I'm trading. That's pretty much how I structure my trades. I always want to have my clear draws on liquidity, and that's exactly what you need for clear draw on liquidity. So, yeah.